So in general, I think Chinese government would like to keep things under control. So I think they are not very used to market volatility sometimes. So as a result, they sometimes try to target the price of the market. And so consequently, I think the pricing signal from the market that's sent is stalled. So it kind of loses some of its use, I think, of sending the signal and price the risk. And I think that's probably an issue. The biggest example is the equity market. For example, in 2015-16, the government tried to bail out and use certain mechanism, and in the end, that meant that liquidity is down, so the market is no longer as effective as before. But that said, I think they understand the issue. They're trying to actually gradually ease some of the controls. Another approach, I think, that maybe they have to think about, the government has to think about, is that they generally are quite relaxed about controls and regulations, especially with new products and new markets, internet financing and so on. And then they try to regulate when something goes wrong. And the regulation tend to be very specific. So I think one way for them to think about it is to set up very clear rules ex ante beforehand to let the market know, and then refrain from intervening in the market directly, but create more of a leveling playing field and clear rules for participants. But we are still some distance from that. So Hong Kong is a international financial center. It has no capital controls, and it has a very established set of rule of law, and it has a pegged exchange rate. That means it borrows basically the monetary policy from the U.S. Where China, of course, still exists some capital controls, and that means the RMB, the currency, is not fully convertible. What that means is that also for people who wants to invest in Chinese financial markets, or for Chinese who wants to invest in international markets, it's not a free flow. There's some controls there. So, and the set of rules and the laws are also different. And China's monetary policy is mainly focused on its own domestic issues and often not very transparent. So therefore, I think there is the two sides are not integrated. But I don't really see that as an issue. I think both financial markets exist to have its own usefulness. Actually, Hong Kong has grown as a financial center. So last year, the IPO amount raised in the Hong Kong Stock Exchange was #1 in the world. And of course, in China, the overall market size is also very large and serves the domestic market. So as a separate financial center, Hong Kong also serves as a sort of experimental ground for China to test some of the products or some opening of its capital account and to learn from it. So I think at this moment that's not an issue, the lack of integration. Looking forward, I think there's still a lot of positive things underlying China's growth in the future. So when we go back to the basics, I would say it's labor, capital, and productivity gains, right? So China still, although there's an aging population, China still have a lot of well-educated people and people who are still engaged in non-productive sectors that can move. And China has very high savings rate. And the productivity level in general are still relatively low. So there's a lot of scope to catch up, invest in the right sectors and so on. And the key to sort of unlock that potential for China's growth, I think there are various structural reforms that needs to be done. I would highlight, for example, state-owned enterprise reforms to basically to create a leveling playing field, and also to increase efficiency in the SOE sector. I think there's also fiscal reforms and local government reforms to reduce sort of direct intervention by local governments or by governments in general in the economy, and they should change their role into providing public service and more of sort of the referee in the market rather than the participants in the market. China, I think the government can create a better social safety net as well. So in general, I would say it's to let the market play a bigger role in allocating resources, while the state, take a step back in trying to have a leveling playing field rather than directly involving in allocating resources. And I would also identify things like better protection of intellectual property rights, better protection of property rights in general, so that could foster innovation and private sector development. So with all these combined, I think the potential that's still there, that China can still grow relatively more rapidly, not as fast as in the past few decades, but I think still faster than the rest of the world. So the Chinese financial system is basically dominated by banks, and the banks are dominated by state-owned banks, and they are large. What China needs to do, and as it has said, but development has been relatively slow, is to allow smaller banks and private banks to flourish, and also let other channels of financing develop. Right now, we have seen a lot of internet financing developed. There is a bit of a need for regulation, but I think that's an area that we could see much faster growth. Shadow banking in China's case has been a bit distorted in that shadow banking has been largely participated by state-owned banks as well, and just basically doing regulatory arbitrage, and most of the funding, or the dominant part of the funding, was not going to new business or smaller companies, but is still going to basically credit constrained companies, for example, property developers or local government platforms, or to hide non-performing loans. So those kind of shadow banking, I think on surface, in theory, is supposed to be good, but in reality, they are just hiding risk and accentuate some of the problems. So I think the changes that's needed in the financial system is probably more developing the capital markets. I think they need to develop the equity market more, not trying to control the market too much, and also allow the emergence of smaller financial institutions to service the smaller companies and new business. For someone that's in the financial market, as myself, I find research that's most useful in that have an understanding. People have an understanding of the market structure and the data issue. So not just the pure standardized theory, but that answers certain questions that are very relevant in the financial markets. Of course, pricing risk is the core in the financial market. But I think in many cases, especially in China or emerging markets, one cannot take the data at face value. One have to understand structural breaks behind the data, and also what are some of the policies that have fostered that change.